Hi, welcome to this episode of Founder Journey. And today I have Vikas Srinath on the show. How are you?
Doing well, Jeff. How about you?
Good, good. So on the show, we talk about insurance, insurtech, and founders journey. And there cannot be founders journey without you involved in the process. And I'm pretty excited to tell our audience about who you are and what you do for all the founders that's out there. So go ahead and take it away.
Yeah, sure. And thanks for having me, Jeff. It's been exciting to see, the insurtech.io platform really become such a widely circulated platform with such engaging thought leadership. I'm kind of glad to be joining the ranks and, hope to continue the conversation with you on and off the pod. I'll say as a
Yeah.
personal point, when we first met over a year ago, your enthusiasm and passion for the industry really struck me. So it's no surprise that you and the team are quickly becoming the voice of the industry. Um, but just wanted to shout you out. I
Thank you.
Yeah, absolutely. So like you said, I'm Vikas. I'm a partner and innovation leader at Prospera Law. We're a full service law firm, catering mostly to venture backed startups. So we help founders with pre-incorporation planning, kind of drive them across their journey towards one day a healthy exit, with all of the sort of kinks in the process along the way.
You have talked to a lot of founders in your life, right? How we met is I was going through Carta, which is a software platform that's very popular, used by investors, VCs, private equities, founders. And while I was talking to them, they introduce us, the third party as attorneys, since they're now attorney firm. And along the way, I had a lot of questions, and you answered them for me. That's how we first met. And I was just like, when this guy's knowledgeable and he's also really easy to work with. So why don't you take us through, like, as a founder, what are some of the things they have to consider? So first I have an idea. And then my idea is gonna go to, okay, I'm gonna go form a team and I'm gonna go try to raise money. What are some of the most things that people think about and then people don't think about, and then what should they be asking you or asking themselves?
Yeah, totally. I think by the time folks get to lawyers, they've already gotten a couple of cautionary tales, either from other founder communities or even from their own experience, right? I think, a lot of the foundational relationships between lawyer and client are built on trust. And a lot of that trust is built through experience and, sort of having, sort of a shared background, a shared understanding of, the issues that are being faced and how they're trying to be resolved in some way. So I think by the time founders get to me, they have a pretty good sense of what they want to do. In many cases, they already have a team, whether it's co-founders, vendors, partners, whatever that might be. And what they're really looking for is a little bit of a backstop to help solidify a lot of those relationships. So right around the time that I end up engaging with folks, some of the first agreements that we'll work through together are like founder sort of set agreements, things like invention assignment agreements, things like vendor agreements, things like contractor agreements. I will say, if there's anything that founders should be thinking about a little bit more, it's thinking about how they can really optimize the legal service. I think people think of legal services as kind of a commodity and less of a partnership in the way that we think about our partnership with clients. And what that means is, as you kind of grow and scale, how do you optimize your decision making to involve the lawyer, to involve the sort of legal advice, to ensure you're really making the best and most optimized decision at any one particular period of time. So that's sort of the general thought process that I give to clients. I think where the relationship starts to really resonate with folks is when I'm able to share anecdotes from other clients across my practice, similar folks who have gone through some of the same trials, tribulations, maybe their experiences along the process, the way that certain actions kind of made them feel, and ultimately like coming up with a decision tree that allows folks to be able to choose what it is they want to do in the way that they want to do it. That seems to be the part of the founder journey that people really value for themselves.
Is there something that is in the founder's blind spot that you consistently notice and you tell them about?
If there's a blind spot, it tends to be um, really around the area of like valuing yourself and valuing your own contributions to a company. I think a lot of this is really framed in the process in really the context of intellectual property and ultimately what is valuable to a startup. But people forget that it's the people that really drive the startups to begin with. So, when we think about how to keep founders motivated to really see an idea all the way through to completion, or really to bring it to market, we think about the right types of incentives to bring across the team to keep people engaged, keep people involved, keep people continuing to iterate and innovate on really the ideas that brought them there in the first place.
So let's flip that coin to the other side, on the
Yeah.
venture side. If I'm building a venture team and I'm using softwares and I'm using your advice, right? What are some things that you start with by engaging VCs on how to use your service?
Yeah, I think that the VC model is really, like you said, the other side of the same coin from the founder journey. A lot of VCs themselves are founders. The process of,
Yes.
finding investor capital, right? Sort of building the relationships to keep that capital committed, creating a thesis and selling that thesis to, really sophisticated investors that write really large checks, and being able to manage their expectations along the process are really resonant points across both the founder and the investor journey. So, when we talk to investors, especially, what they want to know from their law firm is, one, are you guys sort of consistent with your process? Are you reliable? Are you really hands-on, or can we be relatively low touch? Can we trust you to run different elements of, different legal process, everything from negotiating with a founder and a team that you want to invest in, to preparing a kind of a standardized due diligence process that hits all the key points that are important to an investor, and ultimately delivering, work product and deliverables that are easy to understand, they're easy to sort of digest, that give really the key decision points the appropriate flavor that they need to really bring, the major decisions to the decision makers, as opposed to kind of miring them down with all the small details that, frankly, most investors don't really care about, but they rely on our service to be able to accommodate.
Is there anybody who asks you to do things even outside of traditional service from attorney, like vetting people out?
Yeah, we do. And, it's not really something that we charge for. I think of it as good business karma. At the end of the day, we are the company that we keep. Whenever we make recommendations, for example, to non-legal service providers, really important that I get to know them first. So whether it's, going out for a coffee or lunch, getting to know them and who they are, and ultimately the type of client service that they'll be providing, super important to me. Likewise, lots of investors, for example, through the course of, just customary due diligence, will ask us to take a look at founders, whether it's, commissioning companies to do a background check, just having an honest conversation about the way that, they've conducted their business, trying to understand them from both a personality perspective as well as a decision-making perspective. What are the types of things that tend to be top of mind for them? What are the types of things that, even if they aren't important, consistently make their way into their decision-making process? I mean, all of this is, part of general human psychology, but, a lot of it can be extrapolated in a way that's very consistent and very predictable. So both from an investor and a founder perspective, everybody wants to be able to understand what the dynamics are across a table. And where the lawyer can fit in the best, other than providing the strategic legal advice, is really be a foundation and a glue for the discussion that it takes to really get a deal done.
You sound like a lawyer to answer these questions.
I try
I'm
not
curious,
to be honest. Yeah.
curious, what got you in this field? Like, at what point you knew you were going to do law, but what made you say, you know what, I'm going to go work with the venture capital founders area, because this is a niche area at the end of the day. Thank you for watching this video. Now a quick message from our sponsor, Mav.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like Mav to qualify, quote, and hand deliver the highest intent qualified leads to your agents. Mav takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of insurtech $15,000 worth of credit to try Mav. Head to hiremav.com/insurtech to claim this offer.
I have a very personal journey towards it. And the way that I kind of think about it, the story never really begins with me, right? I'm personally a child of immigrants from India in the late 80s, which feels so far long ago. Um, After my parents both moved away from their parents to the US, an incredible leap that I can't even imagine taking for myself. I was born in Connecticut, and I was brought up all over the country as my parents went for their careers, sort of chasing their American dream. I spent a lot of time on the East Coast. I spent a lot of time in India, just kind of growing up, being accustomed to so many different communities, so many different types of people. But me personally now, while I live in Chicago most of the year, I still consider LA my home team, a place I went through grade school and to this day spend around a quarter of the year. So in some ways, like the traveler, the explorer, the curious person in me just remains the same. So I try to take a lot of these experiences and the sort of identity of being new and being different to try and bring a fresh perspective, not just to law practice, but also like my legal career in a way that feels very authentic to me and who I am, right? So today, through my firm, Prospera Law, which is based in Los Angeles, I service a countrywide set of startup clients and investors from like California to Texas to New York to DC, Miami, and of course in Chicago. So having a broad practice around the country gives me a great excuse to do what I love doing, which is traveling, continue to travel and meet new people. I think for me personally, I've always found like startup communities to include a lot of folks like me that not just look like me, but also have similar backgrounds, right? So being new to a place, being a little different than everybody else, but being also confident in yourself and what you bring to the table to approach every context and situation with curiosity. So I'm also a transactional lawyer, right? So I proudly never worn a suit other than in my job interview. And I mostly spend my days in athleisure. So I get to travel, I get to meet new people that look and sound like me, and I'm comfortable while I do it. So it's sort of a natural.
So out of all the places you've been to, why Chicago? Why settle down in Chicago?
Yeah, great question. Well, for me, I ended up following my partner, who was a commercial actor in LA for years and years. During the pandemic, everything shut down in Los Angeles, so we moved to Chicago, where she got into graduate school. I found Chicago to be a really interesting mix of the types of personalities that I found living in New York for the few years that I lived there, along with sort of a small town, sort of Midwestern feel. It's nice to be able to walk around and just have an honest conversation with someone down the street. Everybody says hi to you in a way that I don't think I've ever really experienced in Los Angeles or New York. But most importantly, I'll say for where I am and where I am in my life, the cost of living difference is really impactful. And I found Chicago to be a place that's like very easily accessible. Obviously, I feel very privileged to be in a sort of a white collar profession, but I found the community of Chicago to be very accepting, to be very democratic in a way that I haven't really seen in other markets, and a really great place to like start not just a career, but also building a personal life and a family in some ways too.
That's interesting. I haven't thought about that reason.
Yeah.
So on your plate these days, you work with all kind of founders. What is trendy these days?
Yeah, I mean, I think what's trendy these days is a lot of discussion on politics. I'm sort of agnostic to industry. I think the most number of clients I see these days are clients that have some sort of AI spin to them, whether it's really in the context of like insurtech, for example, or outside the context of insurtech in everything from like supply chain manufacturing to AI agentic work, to large language models themselves and creating new generative AI tools. I think everybody kind of wants to be a part of the hype train, but as things have sort of gone up and down in the public markets, I think AI is starting to mature, not just as a concept for discussion, but also across industry as well, as new cases are sort of being brought to the forefront. So that's really exciting for me. I spend a lot of time sort of philosophizing about AI, thinking a lot about how sort of my clients can use AI, thinking about how lawyers can use AI, and wondering if there's a future for any of us humans in 2050 once AI takes over the world.
You ever say, hey, you know what? Instead of charging fees, I can charge you in shares?
I have thought about that. It's something that we have strongly considered for a number of different clients, and there've certainly been clients that have asked us, and we have declined and regretted it, seeing how their share prices have really ticked up. it's important for us to consider, not just as a law practice, but it really as just a business, ensuring that we have cash flow, right? And I think, the issue that a lot of, equity compensated vendors, whether legal service providers or otherwise, can get into is one in which they have to do a lot of work, a lot of front end work, working with startups and even investors. And typically equity isn't liquid until 7-8 years down the line. So, when we think about sort of our own business planning, we think about the short term, being able to service clients, being able to ramp up as our clients' needs also ramp up. But in the long term, how do we position ourselves to not just make the most of our business, but ideally be able to add value in ways that, we haven't really considered before. What that costs is money. And unfortunately, for a lot of like equity-based, relationships, liquidity isn't really on the table until, year 4 or year 5. So it's a part of an overall strategy. It's something that we're certainly open to. We talk about it a lot with our clients, and we've come up with other, mechanisms to be able to charge in a more deferred manner that gives startups a lot of opportunity to be able to use the cash that's important to them now, also avail of our services, but also give us an opportunity to manage, our cash flow needs as well.
Like some people said on Twitter, I read this post, like, a venture capital talking to the founder in the AI world, when the AI world changing so fast. What cautionary tale can you tell people on investing in the AI world or founder themselves? Thank you for all your support to our channel. Here's a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
Being a deal lawyer and, having really cut my chops, both doing tons of venture deals in my earlier and, current career, I think a lot of people don't appreciate how much money AI startups really need. I think that there's so many different levers, including, hiring the right talent, being able to procure licenses to get the right models in place, being able to get the right resources to be able to support usage of those models costs a whole lot of money. And a lot of startups typically in, some AI related field have a lot of R&D to do, right? A lot of customer discovery, a lot of market discovery that's part of the process. So I've seen a lot of companies, especially those that, raise a lot of money between 2020 and 2021, not be able to produce any revenue come 2024, 2025. Those companies now are running out of runway. And this is probably the worst market to be able to run out of runway. So trying to raise without a sustainable product with just years of R&D doesn't yield a very appetizing situation for lots of investors and certainly for lots of founders that aren't getting the deals that they wanted to get. So I think the biggest cautionary tale is, for a lot of early stage founders, find investors that are capable and that are liquid to be able to back you, not just today, but 2 years from now, 5 years from now, and ideally through exit. And for a lot of investors, make sure that you have the right, sort of investor community around you to be able to continue raise and supporting these startups. A lot of them won't have the type of traction that you immediately anticipated, but a lot of it is also about timing. And 2 to 3 years from now, the market and the demands of the market will look a whole lot different and maybe a whole lot better for what you invested in yesterday.
So I'm going to go back to one of our earlier conversations. When we're engaging with you, I ask a lot of tax questions, right? Being in the venture world, QSBS, you have, and some people play things like qualified opportunity zones, right? Qualified opportunity fund. Do you make recommendations to attorneys on taxes as well?
Me personally, I do not. I try to draw a pretty clear line that I'm not a tax attorney. Having been in the business, though, there's a reason that certain processes are standardized to be able to optimize for a lot of the common tax considerations. And you mentioned a couple of them, right? I think for a lot of early stage investors, QSBS tends to be very top of mind. not just because they're looking at a great opportunity now to be able to invest, but really at the time that they exit, that they can optimize the return that they have without having to pay too much, right, as far as taxes. So it's a lot of that early stage planning is already sort of built into the way that we, provide our advice. But as, some more specific tax questions come up, and certainly on the investor side, as they do a lot of their exit planning, we work with teams of attorneys, and in that capacity, I'm typically the quarterback, right, running an issue from one person to another, providing something that looks like comprehensive advice, and then delivering that advice back to a client in a very holistic manner.
I think I have asked a lot of questions that I was asking myself when we first met. Is there anything you want to share with our audience, when they get into the next phase of their startup, start looking at institutional money, meeting with investors, engaging with you as a service, using other software to track everything?
I think the number one question I get these days, and we're taping this in April 2025, is around politics, right? And is around economic policy. What does it mean to have a certain economy? What does the sort of larger macroeconomic discussion have to do with startups and my ability to raise or my ability to invest in a great startup? I think there's a really interesting conversation to be had at a very meta level about how comfortable people are talking about, economic issues in the context of politics. I think you and I could probably talk about this all day, but, America has kind of retracted a little bit in its ability to discuss issues without becoming very emotional about which side you believe in or which person you believe in. It's very difficult to talk about a subject without someone sort of losing it, either from like an emotional perspective or from like, a political or a standing perspective. So I try to be someone that is willing to have a really engaged conversation, which respects the political opinions one way or the other. Obviously we live in a very divisive time, but there are facts that everybody can agree on, right? I think the new administration, as of April 2025, brought brief but very public equity growth, and also stuck the world with a number of tariffs and a very public trade war that is requiring the administration and downstream markets to live very day by day, with new positions, economic posture, a lot of new legislation struck on a near daily basis, right? I think it's important to kind of zoom out a little bit as members of the startup and venture community, and remember that like venture capital, private equity have always been considered alternative investments to the public markets, right? With the most wealth strategy allocated outside of venture capital and private equity. So I think it's also true that sinking public markets sometimes makes VC and PE more appetizing investments. I think at the same time, regulatory and economic uncertainty makes everyone pause. So, some of the feedback I've gotten on fundraising, especially in like the early stage context, includes things like, hey, we'll wait and see as investors where things are in a month. But that same line has been repeated for many months. We've heard, responses like, well, our investment committee just isn't greenlighting any outside spending until economic policy is more certain or public equities are more stable. And that's caused a lot of deals to sort of like pause or retract in many ways. At the same time, I'm also hearing from the investor side that, a lot of GPs of funds, folks who have a job to go out and invest other people's money, they have mandates. And in many ways, they're waiting for, the market to not just cool and also sort of become more predictable, but they're hoping for better deals as the market potentially even tanks, right? So we're essentially waiting for founders to get more desperate to raise and sell more of their companies at an earlier stage. But it's a little bit of a game of chicken at the same time, because the founders are going to shop the market in a way that, they maybe would not have a year or two ago. So, when I have these types of discussions with both founders and investors, naturally everybody wants to know, well, what's the impact of all of this, right? From both a legal perspective, also a process and investment perspective, from what I see, deal timelines are much slower. I'm seeing much more rigorous financial, technical, legal due diligence, certainly as compared to 2020 and 2021. I'm seeing a lot of flat rounds. I'm seeing a lot of down rounds where companies were unable to really support valuations that they got either in 2020 or 2021. As we talked about before, companies that were expected to run out of runway around now, due to the volatile investment climate, are being forced to shut down. It's not a great story for everyone, but ultimately it's just a tough decision that has to be made. But really in the earlier stage context, and certainly a lot with insurtech companies that I'm working with, I'm seeing a lot more SAFEs. I'm seeing a lot more convertible notes as instruments where founders and investors kind of both agree that setting a valuation in this market can be really difficult to support later. Let's figure out a way to continue building while the times are very uncertain. And ideally, once the market starts to mature a little bit more, we'll reach out, we'll start to get more support, not just from customers, but also from the market as to the appropriate valuation to set for the next round.
If you have any more questions, and I'm sure some of our audience will have, please make sure you follow and reach out to him on LinkedIn and also his website, which we will put a link below in the chat. So, Vikas, thank you very much for coming on the platform, and have a great day.
You too, Jeff. Thanks a lot.
All right.